What if I told you that the asset the world has trusted more than anything else for decades, the asset that pension funds, central banks, and governments built their entire financial systems around, might be losing its sacred status right now? What if the so-called ultimate safe haven is no longer safe? Because this week, something happened that most people are not paying attention to, but history will. And once you see it, you won't be able to unsee it. Hello everyone, and thank you so much for joining me. What we are witnessing right now is not just another market fluctuation, not just another headline that fades away. This is something much deeper. Europe may be starting to sell US Treasuries in response to a growing conflict with the United States, and this move, if it spreads, could eventually trigger something far more serious, a structural collapse of trust in the US dollar itself. For decades, US Treasuries were not just another bond. They were the backbone of global finance. The ultimate safe asset. The place where money automatically flowed when the world became uncertain. Wars, recessions, political crises, none of it mattered. Capital always ran toward US government debt. That assumption has governed markets for generations. And now, for the first time in a very long time, that assumption is being openly questioned. This week, cracks in the US-led global financial system didn't just appear, they widened. Denmark's academic pension fund, a conservative institution representing academics and professionals, announced something that should have sent shockwaves across global markets. It said it plans to exit US Treasuries entirely. Completely. Not by the end of the year. Not gradually over time. By the end of the month. Let that sink in for a moment. This isn't a hedge fund chasing momentum. This isn't a speculative trader reacting to volatility. This is a long-term pension fund whose entire mandate is stability. And the reason they gave for selling was not technical. It wasn't about yields or duration risk. It was political. The United States is basically not a good credit, said the fund's chief investment officer. And long-term, US government finances are not sustainable. That is an extraordinary statement. An extraordinary admission. Especially coming from a conservative European pension manager talking about the United States. For decades, even hinting at something like this would have been unthinkable. But now it's being said openly. And here's the uncomfortable truth, this will not stop with one fund. More investors will follow. More pension funds will follow. Maybe not tomorrow. Maybe not in a panic. But rationally. Gradually. Like dominoes falling one by one. Because the risks are rising, volatility is extreme, and Washington has done something unprecedented. It has undermined global trust not only in its political institutions, but also in the Federal Reserve itself. The independence of the Fed is no longer assumed. It is being tested, challenged, and some would argue, eroded in real time. The Danish fund explicitly stated that US finances are no longer sustainable due to weak fiscal discipline, a softer dollar, and, astonishingly, the push for Greenland. Yes. Greenland. European countries currently own around $3.6 trillion worth of US Treasuries. That's roughly 40% of all foreign holdings. So let's ask the obvious question, what happens if more of them start selling? Yields spike. Borrowing costs surge. The cost of financing US debt explodes. And eventually, if pushed far enough, global financial markets could face an implosion. Now, on paper, the Danish pension fund itself is not a market-moving giant. Its treasury holdings are estimated at only a few $100 million. But this was never about size. It was about timing. It was about signaling. This announcement landed at a moment when global bond markets were already under severe stress. At the same time, Donald Trump reignited threats to unleash tariffs on former allies, including the European Union. Those threats didn't just escalate trade tensions. They exposed how fragile the global financial framework has become. When US Treasuries reopened for trading this week, they found themselves caught in a perfect global storm. Japanese government bonds were already in free fall. Yields on Japan's ultra-long 40-year debt surged above 4%, the highest level on record. This wasn't an isolated event. The sell-off rippled outward, hitting long-dated bonds everywhere, from Europe to the United States. Everything is interconnected. And at the same time, political tensions across the Atlantic were escalating rapidly. President Trump reignited his aggressive push for American control over Greenland. What once sounded like a provocative talking point suddenly came with real leverage, including the threat of tariffs on European countries tied directly to the Greenland dispute. Markets reacted fast. US Treasuries sold off sharply in early trading. The 30-year yield jumped more than 10 basis points, pushing toward 4.95%, the highest level in 4 months. 5-year and 10-year yields climbed to levels not seen since August of last year. And here's the key point: this wasn't random. It wasn't technical noise. It was political risk being repriced in real time. The dollar weakened alongside the bond sell-off, falling to a 2-week low. For the first time in a long time, the United States wasn't acting as the safe haven. It was becoming the source of uncertainty. The Danish pension fund didn't cause this move, but it amplified it. It validated fears that many investors were already quietly holding. And yes, more funds will follow this example. More investors, more institutions, and potentially even countries. What we are seeing is a broader shift in how global investors are reassessing political risk associated with the United States. The environment has become unpredictable, volatile, risky. And this is not happening in a vacuum. Japan's bond market is playing a critical role here, despite attempts by some officials to downplay it. Rising inflation expectations and fiscal concerns have pushed Japanese yields sharply higher. That matters because Japanese investors are among the largest holders of foreign bonds, including US Treasuries. As yields at home rise, the incentive to repatriate capital increases. That means money flows back to Japan, not because of panic, but because of rational yield decisions. And that's where the real danger lies for Washington. If large pools of foreign capital begin flowing home, not suddenly, not emotionally, but structurally, US borrowing costs could rise not temporarily, but permanently. Astronomically. Japan could become the true accelerant behind both the Treasury sell-off and a broader dollar decline. Now add political risk on top of that. Trump pushes uncertainty to its limits. Bond yields spike. Stocks wobble. The dollar weakens. And historically, rhetoric softens after markets push back. But this time, the stakes are much higher. The Greenland dispute is not just another trade issue. It has forced Europe to ask deeply uncomfortable questions about the global system that has existed for decades, and whether it still functions at all. The idea that European countries might weaponize their holdings of US bonds and stocks was once dismissed as absurd. Today, it is openly discussed. But let's be honest. The European Union cannot afford to sell US Treasuries aggressively. It simply can't. European economies have been in a downward spiral for years. Germany has deindustrialized. Growth is weak. A financial crisis would hit Europe hard. Washington knows this. But what Washington either doesn't understand or refuses to admit is that sustained international aggression accelerates the global shift away from the US dollar and dollar-denominated assets. If foreign appetite for US assets weakens further, the consequences will be severe. Higher Treasury yields mean higher borrowing costs for the US government. Higher mortgage rates for households. More pressure on already stretched public finances. A $13 billion auction of 20-year US bonds is approaching, and it will act as a real-time stress test. Weak demand would send another unmistakable signal that something fundamental is changing. The truth is simple and deeply uncomfortable. The United States no longer looks like a predictable actor. Its fiscal trajectory is strained. Its politics are volatile. Its trade policy is openly confrontational, even toward former allies. A conservative European pension fund is no longer asking whether US Treasuries yield enough. It is asking whether they deserve to be treated as risk-free at all. And that question alone represents a profound shift. Because if more investors begin asking it, calmly, rationally, without panic, the long-term impact on global markets could be far greater than any single sell-off. This isn't about tomorrow. It's about the slow erosion of trust. And once trust is gone, it doesn't come back easily. Thank you very much for joining me. I hope this video gave you clarity on what's unfolding beneath the surface of global markets right now. If you found this valuable, please support my work. Like the video, subscribe to the channel, and let me know your thoughts in the comments. Do you think US Treasuries are still the world's ultimate safe asset, or are we witnessing the beginning of the end of that era? Take care, and I'll see you in the next one.